So, hi friends, in this particular session, we just deal with the basics of investment. Like, what do you mean by investment? What is the investment process? What are the various objectives of investment? What are the various investing alternatives available for making an investment? Then it's about you just compare the various investment alternatives available, a comparison between a speculator and investor, a comparison between a gambler and an investor, and that's it. So it's what you are going to see throughout this sessions. Okay, so now let's see a few definitions of investment. So according to F. Ambling, purchase of a financial asset that produces a yield that is proportionate to the risk assumed over some future investment period, which means that at present you are purchasing some financial asset. For purchasing or by purchasing that financial asset, you are incurring some risk, and in future, in proportion to the risk which you have assumed, you are getting some return. So that is what you mean by investment according to Ambling. According to Shah, investment is sacrifice of certain present value for some uncertain future value, which means at present you want to buy something, but for time being you are deciding that okay fine, I will not buy it now, rather I will invest that money for something else, or rather I will invest it in some other options so that in future I may get some return. So since the future asset is uncertain, the return which you are expecting in future is also uncertain. You can view investment from various angles. It can be treated as an asset or an item which you are acquiring for generating income or for appreciation or for upgrading. In economic sense, an investment means its purchase of goods that we are not planning to consume today, but we want to use it to create wealth in future. From a finance angle, investment is monetary asset that is purchased with an idea that it will provide income in future, or later you can sell it for a higher price for profit. So net, in short, when we think what is investment, you will come across some terms like you need return, there will be risk, there will be profit, all those things. So it's nothing but you invest in various avenues available, and for investing you take certain amount of risk, and you expect that in proportion to your risk you will get return in a future period. So this is a common basic understanding about what is investment. So now it's about why do we make investments. Now, why is it so much to bother about investments? It means what is the objective of making an investment. So you have plenty of reasons like safety, rate of return, risk, marketability or liquidity, tax benefits, convenience, and so on and so forth. So let us take into consideration few points that every one of us will consider when we make an investment. So first is safety. See, we all know that the average performance of an investment will normally give you an understanding about whether a particular investment is safe or not. No, every investment is associated with some risk. So if, and we also say that for high risk you will get high return. So it's about the investor to decide whether you have to take more risk and wait for more return, or rather you should play safe. That is moreover the interest of the investor. Every particular investment will have a return. Every particular investment will have a risk. So this risk return combination, high risk, high return. So high risk, high return means it's not that safe. So it is basically your option to decide whether you have to choose a high risk investment to get a high return or you have to play the safe zone. Then second is the rate of return. So it's actually one of the foremost conditions which we make, which we think when we make an investment. So it consists of normally of two parts. One is the annual income, another is the capital gain or loss. Which means that, let me give you an example. Suppose a person is investing in equity shares of a company. So he bought that particular shares for a price of rupees 100. So that company is paying a dividend of rupees 10 for that particular year, and by end of that year the price of that particular share has gone to 150. So which means that your annual income is rupees 10. Maybe every year you are going to get rupees 10. Then initially when you bought this particular security, it was for rupees 100, but now it is 150. So it means there is a increase in the value of asset from rupees 100 to rupees 150. So 15 rupees increase in value. So how can you calculate the rate of return? It is 10 plus 115 minus 100. If you want to get it in percentage, divided by 100. So in this case you will get 25% or 0.25. So that is known as rate of return. Like annually, what is your income expectation for a particular investment, and by the end of the year whether the value of your investment is appreciating or depreciating. So rather everyone will always want a higher rate of return. So they will always want an investment which is providing them with appreciation, and that is what is known as capital gain. Next is risk. So obviously when you are to take investment, you are expecting a return, and the other side of the return is risk. So it is like that, if you take more risk you will get more return. So risk is nothing, it is a deviation of an outcome of an investment than its expected value. We were expecting to sell a share which we purchased for rupees 100 for rupees 120, but due to some situation you were only able to sell it for rupees 100 or maybe 80. So you end up in loss, right? So that is the risk which you are taking. Like safety also, risk is basically depending upon the person who is taking the investment. Maybe some people would prefer to take high risk expecting they will get a high return, and maybe some people want to play in a safe zone, but it is one of the objectives of investment. Then comes marketability of or liquidity. See, it means that whether your investment can be transacted quickly, whether the transaction cost involved is low, and whether the price change between transaction is negligible. Which means that if you want to sell your investment out to get ready cash now itself, whether it is possible or not. If it is possible that you can get off your asset or your investment and make money very soon, you get the cash, liquid cash at your hand very soon, it is rather known as liquidity or marketability. Then comes tax benefit. Tax benefits means basically some schemes, investment schemes have tax benefits. Maybe you will get a reduction in tax if you make investment in particular schemes. Especially in case of mutual funds and all, there are certain schemes which provide you with tax reduction. So that may be one consideration for making an investment. And finally, your convenience. Now, how easy it is to make and manage an investment, that is very important. Maybe a certain type of investment that's rather complex to understand this, its working and all. So maybe you may not feel that much convenient. Maybe some other it is somewhat easy. So maybe you're convenient in handling it. So that can also be a reason for making an investment. So this particular slides gives you reasons for making an investment, or it is basically known as the objective of investment. So now let's see what are the various investment alternatives available for a common man to make an investment. You have so much of options starting from equity shares, then you can invest in fixed income securities. You have mutual fund schemes to make your investment. You have various deposits like post office deposits, company fixed deposit, provident fund scheme, national savings scheme. You have options to deposit in life insurance policies. Maybe precious objects like gold, silver, platinum can make an investment. Financial derivatives, all are the various alternatives available for making an investment. So how you are going to manage your investment into these various alternatives is what you are going to cover in this particular subject of investment management.